We start off with a great tug-o-war in tech. On the one side, the recent high flyers are crashing back to earth today. Just check out ththese moves. Fastly, Etsy, Twilio, DraftKings all plunging. Those names now down at least 30% from their all-time highs. On the other side, the old school value names, Cisco, IBM, Dell, Oracle, not just up today, but many are trading at or near all-time highs. So in this tech tug-of-war, what side do you bet on, Dan?
Well, right now, it seems pretty clear. I mean, the pandemic winners, right? Some of these high valuation, high growth names that were really well situated during just the unique situation during the pandemic, they pulled forward a lot of demand here, and now they're faced with decelerating metrics going forward on all sorts of occasions. You have Fastly down there. Fastly was down 25% today. It still trades at about 10 times next year sales. So, the demand and the pace in which these companies were growing in last year and into this year are just not sustainable at these valuations. I throw a whole nother group though in there, Mel. We've seen some huge IPOs over the last 6 months or so. Airbnb, DoorDash, Snowflake, Palantir, and those stocks are all down 30, 40% from their recent highs, and they may be more comparable to the Oracle, the Dell, the IBM, and the Cisco. And I do think that is a really interesting relationship here, that you're seeing rotation out of these high valuation names into cheap names that are more stable, that don't have the growth. They're just a bit more defensive here.
Yeah, this despite 10-year yields absolutely behaving. I mean, where were we today? 1.56%. Jeff, rates are not scaring people out of the high value tech names. It is something else entirely at this point.
Yeah, so that's the interesting thing. I mean, I think if you look at tech across the board, I mean, I would favor the more value-oriented areas, but you have a Fed that continues to be very dovish. You have rates that haven't really moved. You've had very strong earnings, at least in the case of FANG, and the stocks really haven't behaved all that well, so that doesn't make me feel particularly good. But I do think that the market is at least sniffing out a firming in yield. So you've held that support in the low 150s. You have the copper versus gold ratio increasing, continued weakness in staples, firm European yields if you look at German Bund. So all of those things are telling me that rates are going to start moving higher again. And perhaps this time the equity markets are outsmarting the bond markets. I know it's blasphemy to say that, but perhaps that's what you're seeing this time around. And I'll just end by saying that the real rotation is not necessarily between growth and value, but it's into fundamentals. So growth isn't working within growth. The growthier areas of value aren't working. It's really the factors that are EPS growth, EPS surprises. That's the area of the market where I think you want to be for the foreseeable future.
Okay, so let's say that, as much as you love sock puppets, Guy, you don't want to be in an Etsy in this environment. You just don't. You don't want to be in a Fastly. But is the answer to be an IBM? I mean, is that really the trade that we're looking at this point, do you think?
There are other alternatives. Before we go there, I read on the internet apparently that David Faber is going to be hosting the Jeopardy for a week, which is remarkable. Good for him. And I know for a fact that there was a window of opportunity for you to host Saturday Night Live. But with that read at the beginning of the show, Live from New York, you blew it.
I'm out. Totally out.
You're out.
I'm out. It's too bad. It was my lifelong dream, and it's dashed. It's gone out the window. I'm going to have to think of something else.
Yes, you should. Stick with fast money. It's worked for the last, 12 and a half years. No, listen, I don't think that's the alternative, but I do think this is a really good sign. The fact that some of the froth is coming out, it's like when you drink those cappuccinos at Starbucks. 3/4 of it is all that foam and stuff, but it's fugazi. The essence of it is the coffee beneath, and the essence of this market are the stocks you just talked about, Oracle, Cisco, maybe even IBM. I think this is actually a really good sign that the froth is coming out, and the market's finding value in names that actually have fundamentals and have a reasonable valuation. So I look at all this and say this is a very good thing.
We have played many games on this show over the years. One is value trade or value trap, and so I will embark on that one before we play the next game in a couple minutes, Pete. And that is when you take a look at some of these stocks, like for instance, I'm picking on IBM because we talk about IBM often. Is that a value trade or value trap at this point? I mean, the valuation, the forward PE looks decent. Just if you just look at an absolute number, 13.6, it's up 18% so far this year. But is that going is that going to do you well in your portfolio?
Well, I do happen to think it will, Mel. And as a matter of fact, I own this stock. I've owned this stock for quite a few years. And, you know, the thing that people forget about IBM is, yes, I totally understand. The stock has kind of gone a lot of nowhere, right? But I do like what has changed in terms of the upper management positions. I thought that was something that needed to be changed years ago. They finally did it, and they made that move, and Whitehurst and the gang kind of have taken over. And now it's a story more about Red Hat than it is almost anything else, which was the acquisition IBM made, which was a monster. And I think they are going finally in the right direction. But all that being said, I think it still always comes down to fundamentals, and we talk about that all the time, Mel. We're always talking about PEs and so forth. When we talk about those names, and I was listening to Dan when he opened up, and he's 100% right on this. When we start to look at these names and we're measuring them against sales rather than earnings, I think that says a lot about what these stocks really are. So not only have they pulled ahead, but these are stocks that were in the perfect spot at the perfect time. It was a perfect storm, and that's all great, but going forward, now what? And is there still enough room? Do they have what it takes to actually become real stocks that have real earnings, or are they just going to burn through their cash? And so I look at all those high-flying names that we were talking about at the very beginning, and, you know, the Fastleys and everything else, and I go back to the fundamental story of what we look at when we look at a lot of these stocks. Do they have great management? Do they have great fundamentals? And do they have some form of growth, at least now or somewhere in the future? And I think all of these old-school tech names have been learning over the years, and you can see most of the names that you guys were talking about, they've all added somewhere, it seems to be, in the cloud. And I think that's huge for the direction of where everything is moving right now.
Among the high-flying tech names that have faltered, we named also DraftKings and Penn National. Jeff Mills, you've been interested in these stocks, so down 30% from highs. Do they still look good, or do you say, you know what, we're going to go back to the fundamentals because, you know, maybe 30% ago you kind of like this sector?
Yeah, you know, I think at least in this environment right now, those kind of valuations are going to be out of favor. And it doesn't mean that those aren't good companies or good stocks for the long term. You know, I still believe very much so in the secular tailwinds associated with online gaming and things of that nature. And I know, you know, Penn reported today and it's down big. And I think you have to start to, at least in the near term, try to rationalize the valuations in terms of what's possible, say, over the next couple of quarters, because things have gotten ahead of themselves a little bit. When you think about a Penn and the valuation that was bestowed upon it because of its partnership with Barstool, you know, is 45 times forward versus an MGM who's doing a lot of similar things at 31 times forward. You know, does that gap, does Barstool really make up that gap? I don't know the answer to that. And I think it's going to take time for these stocks to catch up to their valuation. So short term, I do think it could be problematic, but longer term, I do think there are a lot of tailwinds for those businesses that will ultimately help drive the share prices higher. There
was a convoluted metaphor put forth before about froth, and the essence is the coffee underneath, and the froth being fugazi, and it's being, you know, it's 3/4 of the cup, all that. So, Dan, when you take a look at the S&P 500, about 17 points off of record highs here, but we do have a lot of that froth come out, whether you measure it by IPOs, SPACs, software names, or some of the other high valuation tech names. Is this actually a very good sign for the S&P?
Well, it is on a relative basis. So what's happening here, and I can't remember the last time I've seen the S&P up nearly 2x that of the NASDAQ, and that really shows it. The S&P is up almost 12% on the year, and the NASDAQ's up a little less than 6%. And it shows you that there's plenty of names correcting. But Guy brought this up, you know, the mega cap names that, you know, Apple and Amazon make up $4 trillion of market cap. They're two of the largest names in the S&P, obviously, and the NASDAQ also, and they're in a holding pattern. They are going sideways here. And the question you have to ask yourself is, what is the incremental buyer paying for? Because we know that even their valuations are very high. So you have an S&P that's up 12%. It seems to be baking in a lot of the news about rates where they are, about QE where they are, about second half growth, that sort of thing. And so to me, I actually would lean a little bit more on the fact that you're seeing all this exuberance come out of these high valuation names. I suspect there's something coming for the broad market in the not so distant future here, and it could be related to crypto too. If you think about the crypto ecosystem that's gone from $500 billion, let's say 13, 14 months ago, to 2.3 or 2.4, you know, at some point very soon, we're going to see how correlated risk assets like stocks or high valuation stocks are with the crypto markets here too. And I'd hate to see all these things go down together in the same way.
What's your take, Guy, on the implications for the broader markets?
First of all, I take umbrage with the convoluted thing. I don't know how to spell umbrage, but I take it, number one. Number two, I actually do think it's a good sign for the broader market. You know, the fact that we can pass the baton from some of these high flyers to some more stable names with reasonable valuations without really a huge disruption in the broader market, to me, is encouraging. So I think it's a good thing.
Shepard Smith here. Thanks for watching CNBC on YouTube.